A pip can be defined as the smallest price change, and it represents the unit of measurement for all currency pairs. A pip represents the fourth decimal place for all the currency pairs, except for those containing the Japanese yen, where 1 pip is equal to the second decimal place. In some cases, brokers and chart platforms may also show the fifth decimal place. That does not need to be calculated. To calculate price fluctuations, we always start from the fourth decimal place. Let's see some practical examples to clarify our ideas. In this first example, we have a total of 8 pips. In this second example, we have a total of 25 pips. In this third example, we have a total of 473 pips. In this fourth example, we have a total of 3,978 pips. Now let's see some examples for the Japanese yen. In this first example, we have a total of 4 pips. In this second example, we have a total of 19 pips. In this third example, we have a total of 750 pips. In this fourth example, we have a total of 2,433 pips. Let's see some practical examples to calculate the variation of pips from an initial price to a final price. A change from the initial price of 1.1405 to the price of 1.1409 is equivalent to an increase of 4 pips. A change from the initial price of 1.1405 to the price 1.1392 is equivalent to a decrease of 13 pips. Let's now look at an example for the Japanese yen. A change from the initial price of 123.47 to the price 123.67 is equivalent to an increase of 20 pips. A pip, therefore, is the smallest unit of measurement in currency pairs, which allows us to calculate the length of the various price fluctuations. In most financial markets, for each asset, you will find a price to buy and a price to sell. The price to buy is called the ask price, and it is the higher price of the two. The price to sell is called the bid price, and it is the lower price of the two. The difference between the ask price and the bid price is known as the spread. The spread is simply the broker's commission. The term volume refers to the total number of positions that have been opened during a given period of time. The term liquidity refers to the level of rapidity with which an asset can be either bought or sold at its current market price. Volume and liquidity are considered interrelated, because the trading volume is an indicator of the total liquidity in an asset. A higher trade volume indicates a greater overall market interest for a particular asset, as well as an indication of a high liquidity level. Assets with higher liquidity are getting traded more frequently and more rapidly than the ones with lower volume. A lower trade volume indicates a low overall market interest. Low volume assets are being traded less frequently, and therefore have a higher volatility. The volume of the price can be analyzed through the shadows of the candles, often found at resistance and support levels, indicating new volume of orders for a potential reversal. Liquidity is simply the total number of volume active in a given asset. Volatility, on the other hand, represents the speed of price movement. Once the volume of an asset establishes a winner between bulls and bears, it will therefore accelerate in an upward or downward direction, which is defined as the volatility of the price. When the prices of interbank quotes change quickly, it means that there is a phase of high volatility. The highest level of volatility occurs when fundamental news are released. High liquidity allows traders to open and close positions very quickly. This happens because there will always be someone with an opposite position, which will generate the necessary liquidity to be able to close the position. The Forex market is the most liquid market in the world, and any position can be closed instantly. The higher the liquidity, the lower the volatility. The lower the liquidity, the higher the volatility. Liquidity directly affects the technical analysis of a given asset. High liquidity allows the price to correctly reflect technical patterns, while low liquidity does not allow the price to move correctly, creating confusion and having to rely mainly on fundamental analysis. Between the 15th of December and the 15th of January, the Forex market suffers a drastic loss of liquidity, due to a sale of securities by companies and banks, in order to reach their annual objectives, together with a lower general activity due to the Christmas holidays. This leads the Forex market to dry up, and to have a loss of orders, which cause the price fluctuation to increase, becoming unpredictable and unreliable in some situations. At this specific time of year, it is recommended that you avoid or minimize your risk percentage. Another situation in which a lack of liquidity may be encountered is on Fridays from 3 p.m. onwards, before the weekly close of the price. The Forex market, as mentioned above, is the most liquid market in the world. This means that it is the most stable market today, and one that most reflects the technical patterns of all financial markets. The overall liquidity in the Forex market guarantees reliability and trust in traders. It is difficult to manipulate the Forex market, unlike other markets, thanks to the large liquidity it possesses. The average daily range, also abbreviated as ADR, is the daily average movement of a specific currency pair measured in pips, and it is essential to analyze when choosing the currency pairs to focus on, as well as identifying realistic targets for a given period. The best website to analyze the average daily range of currency pairs is Investing. On Investing, go on Tools, and select Forex Volatility. On this page, you will see the average daily range of all currency pairs, for a specific period that you wish. Near the currency pairs, you can see a number that is equivalent to the average daily range. This number indicates the length of the movement of a specific currency pair, measured in pips. The number does not refer to only one direction but both. If you see an ADR of 80 pips, it could mean that 50 pips are bearish, and 30 pips are bullish. The average total movement of the day is 80 pips. By selecting the currency pair that you wish, in this case Euro-Dollar, you will also have the chart to analyze the volatility of the previous days, as well as the most volatile times of the day, and the most volatile days of the week. This tool is very important, in order to understand the best moments to enter the market. Let's say we want to analyze the average daily range of the past 20 weeks. We go back at the top and insert 20 weeks, and then click on Calculate. We can see that the pairs with the highest average daily range are Euro Australian Dollar, Euro Canadian Dollar, Euro New Zealand Dollar, Pound Australian Dollar, Pound Canadian Dollar, Pound Yen, and Pound New Zealand Dollar. The lowest average daily range pairs are Euro Yen, Euro Pound, Euro Swiss Franc, Australian Dollar Swiss Franc, Australian Dollar Canadian Dollar, Canadian Dollar Swiss Franc, Euro Dollar, and Dollar Swiss Franc. We can also see that the exotic currency pairs have a very high average daily range, because they are less traded, and when assets have low liquidity they are much more volatile and risky. The maximum number of weeks that you can analyze with this tool is 54. It is important to constantly use this tool because the market changes continuously, and the average daily range will change as well during the weeks for certain assets. Some pairs such as the Asian ones have usually a low ADR, while pairs that contain the euro and the pound have usually a very high ADR. The pound is the currency that has on average the highest ADR, and is therefore the most volatile currency, in which it is possible to generate greater daily profit but also greater losses. When trading pound pairs, it is recommended to keep larger stop losses due to the many fluctuations that will occur. The pound is a good currency for swing trading. Pound New Zealand Dollar, Euro New Zealand Dollar, and Pound Australian Dollar are three examples of pairs with a very high ADR, therefore very volatile. These pairs do not always respect the technical levels, and different gaps may be encountered between the various sessions, at the opening of the market on Sunday, and at the closure of the daily price. Euro Pound and Euro Swiss Franc are the quietest pairs. These pairs have a small ADR, therefore they have less volatility. You can place smaller stop-loss levels, and at the same time get mediocre profit in the short term. The average daily range is also used to set realistic targets. If you see a high probability setup on Euro Swiss Franc, you cannot think that in one day the pair will move 200 pips in profit towards your target, when it only has an average daily movement of 50 pips. The analysis of the average daily range is essential to decide which currency pairs to focus on, and especially which ones to avoid. If you are a trader who likes volatility and has a low risk tolerance, you will want to focus on high average daily range pairs. If you are a trader that does not like volatility and has a high risk tolerance, you will want to focus on low average daily range pairs. It must be understood that all currency pairs go through cycles and sessions, and what works with one pair may not work in another. When entering the market, it is necessary to have concrete confluences by setting targets that reflect the average daily range of the currency pair. In the beginning, it is recommended to focus on one, maximum two pairs. Professional traders often have a watch list that does not go beyond 4 pairs. For example, by choosing 2 currency pairs, one could be more volatile and the other less volatile, or a major and a minor pair. By choosing 3 currency pairs, one could be a major pair, one could be a minor pair, and one could be a cross pair. It all depends on your preferences. The average daily range will help in the selection of currency pairs, by also being able to understand the days of the week, and the times of the day in which greater volatility may be encountered, to maximize your trading strategy. The take profit is a pending order, that automatically blocks the profit from the current open position. The take profit is used as a profit target, and when the price reaches the set level, the trade will automatically close in profit. The take profit represents a higher price when buying an asset, and a lower price when deciding to sell an asset. Take profit targets should always be set near sensitive areas, such as support and resistance levels. We must learn to exit from a trade at the right moment, especially when the market reaches a phase of reversal or consolidation. If you open a trade for a few hours, but cannot constantly follow the price movements, you can simply place a take profit order and take care of something else. The use of this tool allows traders not to be continuously attached to the chart, to manually close a trading position, but it allows to set targets that will automatically close the trade. Setting a take profit also helps to eliminate emotions involved in the trade. When a position is in profit and reaches a sensitive level, you might think that price could go beyond the identified target, and consequently generate more profit. We always suggest to lock in profits, and follow the profit target that has been set from the start, in order to avoid making serious mistakes related to greed. It is important to set a realistic take profit target, by studying the average daily range of the analyzed asset, to understand how long it will take to reach the identified target. The risk-reward ratio is another fundamental concept that you must know how to apply, in order to constantly gain positive results. We recommend a take profit that is minimum equivalent to the same size of the stop loss, therefore with a risk-reward ratio of 1:1. A risk-reward ratio of 1:1 means that you risk €10 to earn €10. The stop loss must never be greater than the take profit, because in the long term it will potentially damage your trading portfolio. We will study the risk-reward ratio in more detail in the risk management section. A stop loss is a pending order that traders place in advance to limit their potential losses. If price goes against your analysis, the stop loss will automatically close the trade, protecting your capital from further losses. The stop loss consists in a lower price when you buy, and a higher price when you decide to sell. The stop loss will help to eliminate the temptation to keep your trade open, in the hope of getting back into profit, even where there are clear signals to exit from the trade. Hope is an emotion, and emotions are not accepted when trading. The stop loss helps to cut losses, and avoid being attached to one specific trade. If the trade doesn't follow your analysis, cut losses and analyze a better opportunity. The market has endless opportunities. To set a correct stop loss, it becomes essential to analyze the average daily range of the chosen asset, the price per pip, the time frame, and the risk reward. The stop loss is not a tool that should be scary, indeed it is essential to use it to minimize losses, and protect yourself in unstable market situations. It is recommended to set the stop loss 20 to 30 pips under the previous low if you decide to buy, and 20 to 30 pips above the previous high if you decide to sell. Close to the release of financial news, it is essential to open small positions with larger stop losses, to reduce risk and allow bigger price fluctuations under high volatility circumstances. The stop loss can also be moved to the entry price when the trade is in profit. This action is called moving the stop loss to break even. By moving the stop loss to break even, the risk for the trade will be zero, so there will be no loss. Once the trade proceeds in profit of 30 to 50 pips, you can also decide to move the stop loss in profit, ensuring a minimum amount of pips of profit in case the price goes against your trade. The trailing stop loss is a combination between the take profit and the stop loss, and it is used to minimize losses and automatically secure profit for any given position. The trailing stop loss is simply a stop loss that automatically advances if the trade proceeds in profit. Instead of moving the stop loss manually, it automatically follows the direction of your analysis to lock in profits. You can set it with the amount of pips that you want, let's say for example 30 pips. If a trade is in profit of 200 pips and you have added a trailing stop loss of 30 pips, it means that if the market goes 30 pips against the trade will close automatically at 170 pips. If, on the other hand, the trade proceeds to 250 pips in profit, the trailing stop loss will automatically increase, and protect the position up to 220 pips. The trailing stop loss is a dynamic stop loss that automatically follows the trend of the trade. The trailing stop loss can be set right away or it can be added over the course of the trade. Let's say that we open a bullish trade with a stop loss of 30 pips, and we set a trailing stop loss of 10 pips. This means that if price goes in profit of 10 pips, the current stop loss of 30 pips will be automatically moved up to 20 pips. If price then goes against you, you will lose 20 pips instead of 30. Market orders are simply trades, that are being executed instantly. Opening a market order means to buy and sell an asset at the current market price. The trade will be filled immediately, through the bid and the ask price. If you want to buy an asset, your order will be filled at the ask price, whilst if you want to sell an asset, your order will be filled at the bid price. The difference between these two numbers is the spread, also known as the broker's commission. If you see a nice setup, the fastest and most common way to enter the market is through a market order. If there is a phase of high volatility, the interbank quotes of the bid and the ask price will change fast, so you cannot control the exact price in which your trade will be filled at. You will be filled at a random price in that moment. The best time to enter precise market orders is when there is not much volatility. If during high volatility phases you want to enter at a precise market price, then the best orders to use are the pending stop and pending limit orders. These orders will fill you at the exact price that you wish. We are going to analyze the pending orders in the next video. Pending orders are the most precise orders, because they are filled at the exact price that you desire. Pending orders turn into market orders when the price touches the level of your pending order, and therefore your trade will be active. Pending orders are divided into buy and sell stop and buy and sell limit. The buy and sell stop orders are pending orders used to continue the current trend, and are placed above the price for bullish orders and below the current price for bearish orders. These types of orders are widely used by breakout traders looking for the continuation of the current trend. Buy and sell limit orders are pending orders used to speculate in the reversal of the current trend, looking for a higher entry point for bearish orders and lower entry point for bullish orders, to obtain a favorable risk-reward setup. Limit orders are used by professional traders to enter the market at an optimal price level, and to be able to profit in the shortest possible time, positioning the stop loss at a strategic level, to obtain a good risk-reward ratio. Traders who mostly use limit orders are trend traders, and usually use these orders to add positions to the main trend, implementing a pullback trading strategy. The ability to open positions larger than your deposit is due to the financial leverage, also known as the financial multiplier. The leverage is therefore a mechanism that allows the trader to open a bigger position than he actually could with its current capital. By increasing the leverage, your profit may be greater, but at the same time your risk will increase as well. The leverage works exactly like the speed of your car. Driving at a high speed is risky. For this reason, each driver chooses the speed based on its experience, on the road conditions and on the traffic laws. We suggest beginners to use a minimum leverage, in order to avoid excessive risks. As your trading experience increases and your system generates positive results, you can then start increasing your leverage. A price movement of 100 pips, in many currency pairs, represents a rise or fall of 1 cent. This demonstrates how important it is to manage the leverage correctly. In a movement of only 1 cent, which therefore represents 100 pips, inexperienced traders can lose all of their capital, if they do not learn how to manage the leverage correctly. Most psychological issues and mistakes come from a wrong usage of leverage and position sizing. Leverage is simply a loan provided by the broker when opening a trading position. This is possible thanks to an intermediary bank that provides and guarantees liquidity to traders, in order to make the small fluctuations much more desirable and profitable, especially for retail traders with small capital. You can change your leverage in your account settings when logging in your broker's website. Leverage is without a doubt a great opportunity that the Forex market offers, but before increasing it you have to build a solid system, develop an unemotional attitude, and gather lots of experience. It is important to understand that a high leverage represents a high risk, not only a high reward. Leverage is very dangerous, especially when associated with very large positions. A leverage greater than 1 to 200 can cause psychological pressure and increased stress. A 1 to 30 leverage is very good to start off with. Professionals usually use a maximum leverage of 1 to 100. A written strict strategy will help to eliminate the involvement of emotions or temptations at the opening of the trading positions, following a correct risk management. The margin is the amount of capital that you need to have on your account in order to open a specific trade position. The size of a trading position consists in the combination of the lots and the leverage. It is important to calculate correctly the margin to avoid damaging your trading capital. The formula to calculate the margin consists in the base currency unit divided by the leverage. Let's now calculate the margin for a long position of 1 lot on pound US dollar, having a leverage of 1 to 100. The base currency is the pound. The unit is 1 lot. 1 lot is equal to 100,000 units. This means that the base currency unit is 100,000 pounds. The leverage in this case is 100. So 100,000 pounds, divided by 100, equals to 1,000. This means that you are required to have 1,000 pounds in order to open one lot on pound US dollar, with a leverage of 1 to 100. Let's now calculate the margin for a short position of 0.1 lot on US dollar Canadian dollar, having a leverage of 1 to 500. The base currency is the US dollar. The unit is 0.1 lot. 0.1 lot is equal to 10,000 units. This means that the base currency unit is $10,000. The leverage in this case is 500. So $10,000 divided by 500 equals to 20. This means that you are required to have $20 in order to open a 0.1 lot on US dollar Canadian dollar using a leverage of 1 to 500. A high leverage allows to open larger positions having a much smaller margin. This obviously will lead to a greater risk. If you open a position that is too large for the available capital, you could risk losing everything in a short period of time, and therefore receive a margin call from the broker to warn you that the available capital is about to run out. Brokers often send margin calls to clients that exceed a 50% drawdown.